Imagine you stumble across a company that just grew its quarterly revenue by an eye-watering 2,200%. On top of that, it has quietly stockpiled an $11.3 billion treasury of digital assets. By every traditional metric you can think of, this stock should be rocketing straight to the moon. And yet, when you pull up the chart, this very same company is down more than 50% in the first half of the year. It makes absolutely no sense at first glance. So today we are cracking open the hood of Bitmine Immersion Technologies, ticker BMNR, to figure out exactly why the market is aggressively punishing what looks like an unstoppable financial juggernaut, and why this stock crashed despite that massive, jaw-dropping growth. Trust me, the answer is far stranger than you think. If you find breakdowns like this valuable, do me a quick favor and hit that like button and subscribe so you never miss the next deep dive. It genuinely helps the channel more than you know. Now let's get into it. To make sense of any of this, we first need to understand the fundamental dilemma tearing this stock apart right now. On one side, you have a management team executing one of the most aggressive asset accumulation strategies the market has ever seen. On the other side, you have deeply frustrated retail investors and major institutions slashing their price targets left and right. It is a brutal tug of war between the underlying value of what this company owns and the actual performance of its stock. At first glance, this looks like a straightforward growth story, one you could explain to anyone in 30 seconds. But there is one specific financial reality lurking beneath the surface that makes that clean, simple conclusion almost impossible to defend. So let's start with the breaking news from July 14th. Bitmine released their third quarter earnings, and the top line number was genuinely staggering. $46.5 million in revenue. But then your eyes drift down to the bottom line and you spot a massive glaring red flag. An $83.6 million net loss for that exact same quarter. Now, if you are a traditional value investor, this is usually the moment you close your laptop and walk away. But here's the twist, because this is not a traditional business at all. That $83.6 million loss is driven almost entirely by non-cash markdowns on their Ethereum holdings, thanks to recent price volatility. In plain English, it is a paper loss, not an actual operational bleed. No real money walked out the door. But if there is one thing the market absolutely despises, it is uncertainty. And this loss created a mountain of it. Which brings us to the one question every investor actually cares about. What is truly backing this company? Well, Chairman Tom Lee recently put out a rather philosophical message, calling Ethereum the cure for the uncanny valley of wealth. And he is not just talking, he is putting billions of dollars behind that belief. Bitmine now holds a mind-bending 5.77 million Ethereum, which represents roughly 4.8% of the entire global supply. Let that sink in. They are inches away from their self-imposed hard cap goal of 5%. But here's something fascinating that most people missed. Their buying spree has dramatically slowed. This past week, they only scooped up about 27,000 Ethereum, a fraction of their old blistering pace of over 100,000 a week. The strategy is quietly shifting from aggressive buying to careful treasury management. But before you let yourself get too bullish, there is another critical layer to peel back. How is this company actually making money if it is not just flipping its crypto for quick profits? The answer is staking. Staking and network validation now make up an astonishing 98% of Bitmine's revenue, completely overshadowing their old legacy Bitcoin mining operations. We are talking about a projected annualized staking revenue of $242 million. This is not speculative day trading. This is a powerful, real-world cash engine humming away in the background. Think of it this way. They are essentially operating as the largest digital toll booth in the entire world, collecting fees around the clock. Which naturally makes you wonder, if the engine is this strong, why on earth is the market reacting like the sky is falling? When those earnings dropped, the stock initially popped 10%, breaking cleanly above $16 as traders rewarded that impressive cash flow power. But that rally faded almost instantly. Bitmine drifted right back down toward $15.73, dragged lower by broader crypto macro fears and swirling regulatory doubts surrounding the Clarity Act. Retail sentiment on platforms like StockTwits flipped from pure euphoria to visible, bone-deep exhaustion. The chart simply refuses to reflect the massive growth in that underlying treasury, and traders are running out of patience fast. That sounds pretty bleak, doesn't it? But here is where it gets interesting, because if you follow the smart money, a completely different picture starts to emerge. The big institutions are clearly hedging their bets. B. Riley just maintained their buy rating, but they simultaneously slashed their price target from $33 all the way down to $25. They are staring at somewhere between $6 billion and $9 billion in unrealized paper losses on Bitmine's Ethereum Ethereum position, and they are repricing the risk accordingly. And yet, right in the middle of all this bleeding, someone with extraordinarily deep pockets executed a massive bullish call sweep targeting the January 2027 $20 strike. Think about what that means. Somebody is making a heavy, patient, long-term bet that this entire structural narrative will recover, completely ignoring all the short-term noise. So who is right? But to truly understand the risk buried in this stock, we have to examine how they actually paid for all of this. And this, right here, is the absolute core of the bear case. The one thing you simply cannot afford to ignore. To fund this enormous Ethereum grab, Bitmine raised $273.8 million through a Series A perpetual preferred stock offering. And that money did not come cheap. It carries an incredibly expensive 9.5% coupon. Now, yes, their current staking yields comfortably cover that dividend today. No problem at all. But here's the catch that keeps analysts up at night. This safety net is entirely tethered to two things that nobody can control: fluctuating network yields and the volatile spot price of Ethereum. And that leads us straight into a genuinely terrifying hypothetical. What happens if Ethereum takes another sudden 20% dive? What happens if those staking yields start to compress and shrink? My single biggest fear when I look at this company is what I call the $1,200 threshold. If Ethereum breaks below $1,200, Bitmine mathematically cannot yield its way out of its debt obligations. It becomes impossible. They would be forced into a dilution death spiral, printing new shares just to pay those preferred dividends, and permanently destroying value for everyday common shareholders in the process. Make no mistake, they are walking a razor-thin tightrope, and the wind is picking up. So the natural next question is, how do you actually trade a setup this volatile over the coming days? In the very short term, Bitmine is behaving like a highly leveraged, high beta proxy for Ethereum itself, amplifying every single move. Right now, it is desperately clinging to a critical support zone between $15.40 and $15.50. If that level snaps and gives way, the technicals turn downright ugly, and we could witness a rapid slide down toward the Fibonacci bear case support sitting around $11. On the flip side, the bulls have their work cut out for them. They need to crack the heavy resistance sitting at $16 and then ultimately break out into the $20 to $26 range to prove once and for all that this brutal downtrend is finally over. But if we zoom out for a moment, the technicals cannot answer the hardest question of all, the question of what this thing is even worth. And honestly, I am torn, because traditional finance metrics are completely short-circuiting when applied to this company. Look at their price-to-book ratio, and it sits at roughly 0.8 times. Compared to a software industry average of 2.9 times, Bitmine looks obscenely, almost historically cheap. It is practically screaming bargain. But then, if you run a standard discounted cash flow model, those deep operational paper losses spit out a fair value of literally 1 cent per share. One single penny. So which metric is telling the truth? The reality is that standard equity valuation models are utterly broken for this particular stock. They simply were not built for something like this. But here's the beautiful part. The paradox actually resolves itself the moment you change how you categorize the company. You have to stop thinking of Bitmine as a traditional tech equity altogether. What it truly is a closed-in crypto fund masquerading as a stock. That is the key that unlocks everything. The real value lies solely in that $11.3 billion treasury and the very real staking cash flow it generates. Those standard quarterly net income figures, they are just a distraction, permanently skewed and distorted by non-cash markdowns. The moment you view it correctly as a fund, the discount to its underlying asset value suddenly becomes the entire story. And that revelation brings us to a major pivot happening right now, quietly, inside the boardroom. Bitmine is transitioning out of Phase 1, which was aggressive dilution to capture as many assets as possible at any cost, and into Phase 2, which is carefully managing a cash-flowing treasury. On paper, technically speaking, this pivot should be wildly bullish. It significantly reduces the risk of future share dilution, one of investors' biggest fears. And yet, the market does not seem to care one bit right now. Why? Because investors have zero trust left in the tank. Until management can actually prove they can return capital to common shareholders, rather than just endlessly servicing those expensive preferred dividends, the market is going to remain deeply, stubbornly skeptical. So let's pull all the pieces together for the final verdict. On the bull side of the ledger, you have a massive hard asset treasury, a $242 million cash flow engine, an obscenely low price-to-book multiple, and clear evidence of smart money quietly betting on a big 2027 recovery. But the bear side of the scale is heavy too. You have an expensive perpetual preferred stock obligation weighing everything down, an absolute reliance on Ethereum staying above $1,200 to avoid that dreaded dilution spiral, completely broken chart momentum, and total palpable retail exhaustion. It is a genuine battle of extremes. Before we get to the final takeaway, I need to be crystal clear about something important. Everything I have shared with you today is for educational and informational purposes only. I am not a financial advisor, and this is absolutely not financial advice. Investing in stocks, and especially in highly volatile crypto-related equities like this one, carries significant risk, and you could lose money. Please always do your own thorough research and consider speaking with a licensed financial professional before making any investment decisions with your hard-earned money. With all of that said, here is the bottom line. Bitmine Immersion Technologies is simply not for the faint of heart. It is a highly leveraged play on the entire future of decentralized finance. Yes, the underlying assets are genuinely staggering in scale, but the structural risks tied to those dividend obligations are just as extreme. Until management can prove they are capable of navigating this debt and actually rewarding the common shareholders, Bitmine is going to remain a wildly volatile battleground for bulls and bears alike. Keep a very close eye on that $15.40 support level this week, because it is going to tell us just about everything we need to know about where this stock heads next. Now I want to hear from you. If Ethereum somehow dropped to that terrifying $1,200 threshold tomorrow, would you be brave enough to buy this dip, or would you run for the exits? Drop your honest answer in the comments below. I read every single one, and I would genuinely love to know where you stand. And if this breakdown helped you see this stock in a whole new light, please smash that like button and subscribe for more no-nonsense deep dives just like this one. Thanks so much for watching, and as always, stay rational out there.